I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, full control. WeWork considers a SoftBank bailout. This comes as the co-working space is on the verge of running out of cash. We have the latest. Plus, cutting losses. Uber CEO fires hundreds of employees, all part of plans to revamp the company and address investor concerns. The stock price is down about 30% since its IPO. And fake out, digital ad fallout after Democratic presidential candidate Elizabeth Warren posts an intentionally false ad on Facebook. More on social media's role in separating fact from fiction. But first, our top story. WeWork is considering a bailout that would hand over control to SoftBank Group. Bloomberg has learned that the Japanese investment bank is convinced it can turn around the once high-flying startup. WeWork is also weighing a $5 billion debt financing led by JP Morgan. To discuss, I'm joined by Bloomberg's Michelle Davis, and also here with me in studio, Bloomberg Technology's Ellen Hewitt, who covers WeWork for me. So, Ellen, let me just start with you. I want to separate the two different deals. First, SoftBank taking control. What can SoftBank do that the other co-CEOs right now aren't able to do?
That may be a point of debate within this discussion that's going on between WeWork and SoftBank. You have to imagine maybe investors such as SoftBank are coming in and saying, look, the track record with this company is not good. Maybe we don't, we like that you have two new co-CEOs, but we're interested in doing more. And if they did take a larger stake in the company, maybe they could have control that would change the company around. So I think the discussions on the table are probably about mid to long-term plans around profitability, trying to get expenses under control, all the things that WeWork has really been criticized for in the last couple months.
Michelle, let me bring you in here. This all comes down to the need for cash. If SoftBank were to come in and take control, do we know how much money they would invest, loan, put up, whatever sort of the term is here, to get WeWork to 2020?
Yeah, I mean, at this point, all of that is still very much in flux, and I think what it all comes down to between, the JP Morgan debt package and then this potential package from SoftBank is who can get everything together quick enough for WeWork, because at the end of the day, what it really does need is this cash. On the JP Morgan side, we know that they're leading talks with as many as 60 investors for a debt package that could be around $5 billion. And so a lot of it's going to, come down to how much SoftBank can pull together and if it can do that faster than what the banks are doing.
So, Ellen, you heard Michelle mention that $5 billion deal from JP Morgan. Is that a separate issue here, or are those two being tied together?
So they're both on the table, and it sounds like, although they're likely pretty different plans, it seems unlikely that both would be taken in extreme. There could be some overlap. So it sounds like the board of directors and other people with influence are meeting this week. We don't know exactly when, but it sounds like discussions about this are ongoing, and we expect to hear more about it maybe in the next few days. But it seems like both are somewhat on the table. There's going to be some decisions coming up.
Michelle, I want to show you a chart here for the Bloomberg audience that I'm showing that we made inside the terminal, and it shows, sort of a rebound from record lows. The bonds, frankly, are having a pretty good day, trading at 91 cents on the dollar. Michelle, if there were to be a debt financing, what is the appetite right now for a junk deal?
So, it's interesting that you bring up the bonds, because if you look at that graph or the chart, the bonds were trading at pretty distressed levels amid all the turmoil related to the IPO. And then last week there were reports that, WeWork was facing a larger than expected or sooner than expected cash crunch. And when we reported that they were, pulling together maybe $5 billion of debt, that's when the bonds did increase, or the bonds did, rally. And so that actually helped their borrowing costs. But it's still to be seen how much appetite there is from bond investors for a deal like this. Going into the end of the year, sometimes it's harder to get risky deals like this, in the high yield bond market done, unless there are some pretty lucrative or sweetened terms offered to them.
And Ellen, I want to take a look at another chart that we've made here, which shows the yields of WeWork about 10% relative to Uber and Tesla, some other risky companies that we talk about, and they're 300 basis points, yielding more than Uber and Tesla. On Friday, we spoke, and we were talking about some of the terms of the condition, 425 plus LIBOR. Any sense, again, we don't quite know the appetite for a junk deal, any sense of what these broader terms might be, given they're now commanding a 10% yield?
I'm really not sure. I think we just have to kind of keep following the news of where they're going to turn to for cash. So we reported last week that the crunch is coming, that there could be problems as soon as next month if they don't get more money. You know, this is a company that spends a lot and doesn't really have a control over its expenses. We've seen in the last couple of weeks they've been trying to cut certain parts of the business. They're exploring layoffs of a significant part of the workforce, just trying to get expenses under control.
Michelle, our colleague over at Bloomberg Opinion, Tim Colpin, came out with a Bloomberg Opinion piece and pretty much wrote that the damage to SoftBank by backing up WeWork again would be much more than any billion-dollar investment. What is the damage to SoftBank if they step up to the plate here?
I mean, it's an interesting opinion brought up, but at the end of the day, SoftBank already has put a lot of money into this company, and so for them to just walk away, probably, you know, you'd have to weigh the hit to their reputation that would happen if they did that with, the amount of money that they're going to have to put in to help turn WeWork around. It's kind of the same story with JP Morgan. You know, they already put a lot of money into this company. They've taken a reputational hit, and at this point, they kind of just have to bite the bullet and, help turn the company around, put good money after bad money.
Yeah, and Ellen, finally here, where does the company stand in their strategy despite all of the background noise? Do they continue to try to push forward, sell off some of the side investments, save cash? What do they do going forward in the next few weeks as the rest of this gets hashed out?
I mean, we've seen some hints already of how they're likely to try to approach this. It seems like, last week they said they were going to close their private elementary school, WeGrow. They still have several businesses up for sale. None of those have been sold yet. They're selling the Gulfstream jet. There were some reports that they were maybe freezing the opening of new locations. My sense is they are really hunkering down and trying to get expenses under control while they figure out how to move forward. And again, I think a major cut that they're likely to make, as the co-CEOs have told staff, they're likely to cut a lot of jobs probably this month, starting very soon. So I think it's just trying to get the core business under control.
Back down to the focus on the core business. That was Bloomberg's Michelle Davis and Ellen Hewitt. Thank you both for joining me. An Indian fintech startup, Paytm, is close to getting $2 billion in new financing. Bloomberg has learned that investors include SoftBank and Jack Ma's Ant Financial. The funding values Paytm $16 billion. The company is India's top online financial services firm. And coming up, this week starts earnings season, what you need to watch out for as the big banks start reporting this week. That's next. This is Bloomberg. Earnings season is underway with banks reporting throughout the week. JP Morgan, Goldman Sachs, Citigroup, and Wells Fargo all report Tuesday, Bank of America Wednesday, and Morgan Stanley Thursday. Here with a look at what to watch when it comes to technology, it's Bloomberg's Shonali Bosek. So Shonali, talk to me first. What are the bank's technological priorities here as we take a look in the technology space?
Sure. So you actually have the big consumer banks that are spending the most money on technology. You have JP Morgan and Bank of America, each annually spending more than $10 billion, even in an era where we're watching the banks keep a big lid on costs. Why are they spending the most money? Because they're the ones that are going after the millennial consumer in terms of digital banking, in terms of digital payments. And so you can see them really doubling down in this era, while the other investment banks, they'll focus more on electronic trading, for example.
Yeah, so within technology, what are we looking to hear from them specifically in terms of what they're hiring, digital payments, all of their technological advances?
Sure, we've been hearing from banks for a while now hiring more coders, for example, because they're focusing more on electronic trading. And as you could see in this chart here, that digital banking is the #1 thing that people are looking at. With that said, I wouldn't get too scared right away because they do have a lot of branch networks still. But you could see some more surprising statistics, some things that are not high up on that list. Blockchain is still a relatively small percentage on what people are looking at in terms of hiring and expenditures here. And same with biometrics and AI even though you hear so much of artificial intelligence taking over other parts of the financial industry like investments.
And when you see digital banking there, about 53%, a lot of this comes from the peer-to-peer payments, like a Zelle, transfer from digital banking and digital mobility. How much is Zelle going to be sort of the future of banking here for companies like Bank of America?
Well, it's certainly something for Bank of America. When they report on Wednesday, they actually go up right away, and you can see the figures in their earnings report very high up, that the Zelle figures are a straight arrow upward, and it's pretty significant, and it's an exponential growth. So it definitely is a very big future for these banks, including JP Morgan, and not for necessarily Zelle, but in terms of digital payments. But Bank of America does highlight their relationship with Zelle, for example, and both banks definitely highlight their digital payments and the appeal that they have to younger customers in particular.
Shonali, as revenue remains uncertain, we're in such a volatile environment. Do the analysts that you speak to think that it is a good idea that these banks are continuing to invest in technology, increase investments in that space, even though top-line revenue growth can be elusive at times?
It's definitely true. If you talk to analysts and also the big investors in these big financial companies, they know that Apple's a threat. They know that Facebook is a threat. And so they like to see these banks that are investing more in technology to prepare themselves to the future, because their traditional business lines are really pressured. If you look at trading, fees have been pressured all year. In terms of loan growth, their loans are growing, but interest rates are very low. And so people are going to want to see these banks really transition into a new era while also attracting more customers in a place that's very competitive. A lot of these analysts and a lot of investors compare them to their Chinese counterparts that have seemed to crack the code in terms of digital payments and attracting people through more online methods.
And is it just the big banks, or what banks are poised to really outperform given the transition to be more of a technology company than a traditional banking company?
Sure, Taylor. If you take a look at it, it's actually the payment companies, the Visas, the MasterCards, the global payments of the world that are outperforming versus the banks for those same structural headwinds that we've been talking about. And so you can see people betting on the banks that are investing more in technology and winning in that respect. A lot of them are investing and not seeing a lot of growth. But payments, if you look at the stock chart, they can't be denied that they are winning in this investment race. Investors are flocking to things that are able to transact online.
Well, good look at the banks and sort of the increase over into the technology space. That's Bloomberg's Shonali Bossack. Thanks for joining me. Now, I want to transition to Uber. Uber CEO Dara Khosrowshahi continues to try to reduce losses, this time by firing about 350 employees. The cuts hit a handful of divisions, including self-driving car development and food delivery. Uber also dismissed more than 800 employees over 2 rounds of cuts in July and September. Joining me to discuss is Bloomberg Technology's Lizette Chapman, who covers the company for me. So first, start with the 350 that we learned about today. What do we know about those layoffs?
Right. So the way that it was described in a company email, Dara Khosrowshahi said that this would be the last in the wave of cuts that he had promised last spring. So as you mentioned, they had some cuts affecting marketing, product engineering, and they also, now with this, it also extends into Uber Eats and autonomous driving. So it increases the total number of people that have been laid off to just around 1,200 or so. Investors seem to like that, and the stock, which has been trading about 30% down from its IPO from May, bumped up a little bit, about 4% up for today.
So you mentioned this is the last wave. We also got the 800 in July and September. How are those cuts different department-wise, geographically, from the cuts that we got today?
Right. This is part of a larger strategy that the CEO laid out back in the spring, saying, hey, if you were to design Uber from scratch, what would your department look like? And went department by department by department after investors just hammered it with the, trading it down, saying, hey, we got to see some profits. And as we've talked before on the show, it did deliver a $5 billion loss, during its first quarterly report. Not a good look. Your question was, how is this different? It's a continuation of what he set in motion back in spring, and he said that this would be the last of that wave of cuts. Whether another one's going to come, Who knows? We just know what we're able to report and we're able to confirm.
I'm glad that you brought up a $5 billion loss number, because you look on the FA function in the terminal, we see that they're projected to lose $6 billion by the end of this year. Are these cuts enough to offset that, or it's just a step in the right direction?
Yeah, it's not going to touch anywhere near the $5 billion or $6 billion, what you saw in the terminal earlier. To be clear, though, that $5 billion loss that was reported the last quarter, a big chunk of that, over $3 billion, was related to one-time IPO costs. So it's not something that it's going to supposedly come back again for the next quarter. That's something that they're going to be watching closely, looking to keep an eye on how their expenses are going, to make sure that that they are able to deliver that all-elusive profit, which so far they haven't been able to do.
Is the pressure coming just because the stock's down 30% since the IPO?
I think that that's definitely a factor. No matter what, no matter what way that you look at it, it's not good to have your stock trading below where it IPO'd. The other issue is part of this larger transformation that Dara is attempting to do now since inheriting this company from its previous CEO, founder, Travis Kalanick, which is not a growth at all costs mentality. It's a continued growth. But let's take a look at profit now as a public company. You
mentioned growth. So finally here, what do these layoffs mean for their expansion plans? I mean, you've talked about the big investments in autonomous driving, Uber Eats. I mean, how do those now fit into the core Uber ecosystem?
They still have all of those things. It's just slightly smaller department across all of these different lines that we've outlined before, as well as geographically. About 70% of these cuts that were announced today are coming from North America. The other 30% is spread out across the world globally, because this company still needs to and wants to grow.
Bloomberg Technologies, Lizette Chapman, thanks for joining me.
Thank you.
And coming up, Apple is surging on unexpectedly high iPhone demand, but catching criticism for sending web browsing data to China's Tencent holdings. More on Apple and its complicated relationship with China next. This is Bloomberg. China may be winding down its fight with National Basketball Association. Tencent live streamed 2 NBA games played outside of China, and the New York Times says that editors at state-run news outlets have told reporters to stop emphasizing the NBA issue. Tensions flared after the general manager of the Houston Rockets tweeted support for Hong Kong's protests. That led the country's state-run TV network to quit showing NBA games. Meanwhile, Apple is coming under fire on Monday for sending web browsing data, including IP addresses, to China's Tencent. This is the latest criticism of how the company operates in the world's most populous nation. To discuss, I'm joined by Bloomberg Technologies' Mark Gurman, who covers all things Apple for us. So, Mark, quickly walk me through here what today's news about what Apple shares with Tencent is different from what they were doing before.
I mean, to answer your question pretty simply, it's not really any different. This is more of a revelation that has come in light of the last week or two of discussion about the way China and Apple have been working together and how Apple has been operating, like you said, in the region. This comes down to a safe browsing feature. It's actually pretty simple in practice. Basically, they use Google outside of China and Tencent in China to verify websites you go to, whether they are malicious or not, in order to protect you from going to a website that may steal your data. And as part of that, Apple could send user IP addresses, which is a way to get your location, to both Tencent and Google. And the question is Tencent really receiving that location data? How big of a concern is that? And that's what people have been talking about this morning, and that's really what the issue comes down to.
And how valuable is this data to Tencent?
Yeah, I mean, it really is unclear how much data Tencent is really getting. If they were able to actually get user location data, it's very valuable in the sense that Tencent is known to have strong affiliation with the Chinese government, which obviously here in the US, that is not something that people would be fond of, Apple providing user location data to a government-affiliated search engine, right? It doesn't appear it actually goes that far. It doesn't appear anyone's location data is actually in danger. This is just a lot of people responding and criticizing Apple, given what we've seen the last 2 weeks following the NBA revelations that you so elegantly outlined.
And Mark, I want to transition because you also had a really good story out, again, highlighting the big demand for the iPhone 11. Does this all come down to the fact that it's $50 cheaper than the similar or comparable model a year ago?
Yeah, that is certainly one component of it, the 11 starting at $700 instead of $750. But we found that the bigger thing probably is that this year a lot of people are due to upgrade, right? The average US consumer, certainly not me, tends to upgrade their iPhone every 4 years or so. 4 years ago is when the iPhone 6 and 6 Plus and the 6S and 6S Plus were the hot new toys, right? Those are the first time that Apple increased the screen size. They split the line into two different variations, big and small. And 4 years is up, right? It's almost 5 years since those phones come out. Those ones are having batteries that are starting to give out. The processors are quite sluggish. They're losing compatibility with iOS 13, the latest services. It's time to upgrade, and that so happens to be this fall. And so that's why you're seeing a lot of people, combined with that $50 price cut, jumping on these new models.
And the street has been really, really bullish on this. Any effect, given that we got a potential phase 1 trade resolution on Friday? We know that the 10/15 tariffs won't go into effect, TBD on the December 15. Any idea if that's also boosting demand, if Apple doesn't have to pass on those higher costs to the consumer?
I don't think so. I don't think that's something consumers are thinking about. Apple is not impacted one way or another by these 10/15 tariffs, whether or not they were going to go into place or not. But from an investor and an analyst standpoint, these 10/15 tariffs not going into effect, like you said, could give some optimism that the December 15 tariffs will also not go into effect. Obviously, we don't know that, but I think it's still too early to tell for consumers seeing any impact, at least on iPhones, from this trade situation.
And Credit Suisse also coming out with a note saying that they're really bullish on this also because when you take a look at the average selling price, this also gives some momentum to that average selling price that's so key to earnings. What's the number one thing you want to hear about on earnings on October 30th?
Yeah, I sort of disagree with Credit Suisse on that point about the ASP rising because of this. I actually think that the ASP might go down quite a bit. One thing that's lost in all this positivity around the strong iPhone demand, which to emphasize is a very good thing for Apple, is that they're still likely to be down year over year on these iPhone sales and the ASP going down as well. So we'll be looking to see how down the phone is year over year. But to answer your question, the most important thing will be their holiday quarter Q1 forecast for 2020.
Tempering some of the bullish thesis, it is none other than Bloomberg Technology's Mark Gurman. Thank you for joining me. And coming up, Senator Elizabeth Warren is going after Facebook again. This time she's using fake ads to warn of dangers ahead of the 2020 elections. We break it down next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Democratic presidential hopeful Elizabeth Warren is taking on Facebook's political ad rules, and she's doing it by buying ads on the social network. The Democratic senator bought an ad that falsely read, quote, "Breaking news. Mark Zuckerberg and Facebook just endorsed Donald Trump for re-election." Warren's going after Facebook for refusing to fact-check politicians' ads. This comes after Facebook's fact-checking policy allowed Trump's team to share ads alleging that former Vice President Joe Biden promised Ukraine $1 billion for firing a prosecutor. That's an ad that the Biden campaign has dismissed as smear tactics. Joining me to discuss it all, it's Bloomberg's Sarah Fryer, who covers Facebook for us, Eric Newcomer, who covers the intersection of tech and politics, and on the phone I have Jeannie Zaino, Iona College political science professor and applied techonomics senior advisor. Sarah, let me start with you. Just talk to us how we got here to this fight between Facebook and Elizabeth Warren.
Well, from a broad level, we're looking at this fight about what impact Facebook has on the election, whether they act or don't. Facebook has an algorithm that subtly can manipulate what we see in their feed. They have these rules that they apply about what can stay up and come down. And Warren is really calling them out here for saying that
by taking no action. They're actually taking action. And the funniest thing was Facebook responded to this by tweeting out against Warren and saying that, well, the FCC doesn't want broadcasters to discriminate on candidates' ads, so we don't want to either. And Warren clapped back at that and says, you're making my point here. You are not regulated.
Well,
the broadcasters are regulated.
We have the tweet here showing that the FCC basically is what Elizabeth Warren is saying of, you're making my point. It's up to you whether you take the money to promote lies. And so, again, sort of making her point, if you will.
Yeah, absolutely. And so I really think what this shows us is that the election is going to be about Facebook's, like the discussion about the election. It's much easier to run against Facebook here than it is to run against the opposing candidate, because Facebook does hold a lot of controls, subtle or direct controls over what voters will ultimately see.
Eric, as you take a look at the intersection of tech and now folding in politics, what does this fight show you from the political angle about how much tension there is between big tech and some of these Democratic candidates?
Well, I agree with Sarah. I think, they're working the refs right now. There's a push among conservatives to really make sure that Facebook and Google, allow a wide range of sites, some that, journalists would say might not pass fact checkers, and certainly the Democrats have been arguing that as well. So you see sort of this jockeying of pressure, conservatives on the one side, Elizabeth Warren and Democrats on the other, sort of pushing Facebook to police what's on its advertisements. So it's not so much legislation at the moment as just sort of political pressure. And certainly Facebook knows that this pressure is coming as all these different politicians get to weigh in on antitrust investigations that are going to progress and privacy legislation that could come up at some point. So it's sort of, they need to stay close to these politicians while the politicians have all these interests around what speech is allowed on the platform.
Jeannie, as a political science professor, what is your take on this fight between Elizabeth Warren and Mark Zuckerberg?
I think it's illustrative of how far we have come. I mean, it is astounding that now you have one of the leading candidates in the race for 2020 taking on a big tech company, and she is leading the charge, and other Democrats and Republicans, as was mentioned, is sure to follow. And that is, far and away from where we were just 4 years ago, let alone 8 years ago. I mean, I'm old enough to remember Barack Obama's campaign when having a website was a big deal, and you think about how far we have come now. I think part of the problem here, as we look at what Elizabeth Warren is saying, is that it is narrowly focused on Facebook and Mark Zuckerberg in the context of this 2016 and what the Democrats did. Certainly not her plan, but the way that she talks about it. And I think there are much larger questions beyond Facebook, beyond Mark Zuckerberg, that need to be addressed that still sort of haven't resonated popularly. And certainly her plan does address. She has a 4-part plan for breaking up tech companies, or, breaking up is probably an overstatement, but addressing some of these issues. There's a lot of potential legislation out there, but all of the attention at this point seems to be focused on Facebook because of its role in 2016. And to me, I think from a legislative perspective, that's a bit of a problem.
Jeannie, is Facebook taking the right approach here, in your opinion, of sort of being hands-off, not wanting to police content, not wanting to do a lot of fact-checking, sort of just being the messenger here? Is that the right strategy?
I am astounded, and I think Sarah said it earlier, by their response to Elizabeth Warren. It is not a good idea normally for a corporation to say we are like those networks that are regulated by the FCC, because what they're doing is inviting in regulation. They are far better off staying the platforms that they are, where, oh, by the way, since 1996, they've been protected from challenges in terms of libel and aren't regulated. And if they have public pressure, self-policing certainly makes sense. But the statement they made really opens them up now to the argument that several people have been making, which is that you, too, should be regulated. That is not a good strategy in my estimation. I don't know how in the heck that got through Facebook, and they allowed that to be the statement they put out.
What does this mean, Sarah, for them as we approach 2020? It feels like the pressure only heats up.
Well, absolutely, and I think that Jeannie made a great point, which is that Facebook has for years said, we are not a media company. We are a neutral technology platform. We just, are a place where people can talk about whatever they want to talk about and see whatever they want to see. But that in and of itself is not a neutral stance. And so I think what we're going to see ahead of the 2020 election is politicians pressuring Facebook and pressuring Facebook. Maybe if Facebook makes a change, it'll help their campaigns in a way too, the way Facebook ended up helping Donald Trump in the 2016 election, not just by ignoring the Russian influence, but also by assisting his campaign and running their advertising that ended up playing to people's fears.
Well, so much still to discuss as we approach those 2020 elections. That's Bloomberg's Sarah Fryer, Eric Newcomer, and Professor Jeannie Zaino. Thank you all for joining me. And I want to stick with Facebook because the social network's proposed cryptocurrency, that's Libra, continues to lose backers. On Monday, Booking Holdings, that's the parent company of travel sites like Kayak and Priceline, jumped ship from the Libra Association. That means that Facebook's group has lost now 1/4 or 7 of its 28 founding members. Others that have left include MasterCard, Visa, eBay, and PayPal. Joining me to discuss Bloomberg Business Week's Max Chafkin. Max, what is the significance that you now have 7 of 28 out?
Not the direction that Facebook was hoping this would go when they unveiled Libra. What you're seeing here is that there has been a huge sort of public pushback from regulators, both in the U.S. and in Europe, to the idea of Facebook basically, along with a handful of these other companies, minting its own currency, and the fear is that that currency could sort of weaken the power of national currencies. What's interesting here is we have a bunch of the sort of most reputable payments people getting out. Last week, there was a letter from 2 Democratic senators that basically said, you guys better be careful here, because if you are getting involved with these potentially unregulated payments with Facebook, we might look at your overall business. So you have these companies saying, hey, it's not worth it. The other thing here is just to Facebook's strategy. We have Mark Zuckerberg coming to Congress to testify on this, I believe, next week. So, this kind of just will potentially change the dynamic there. We might expect lawmakers to talk a little bit less about Libra, maybe a little bit more about some of Facebook's other issues.
It's interesting that you brought up that letter from the Democratic senators. It felt like a lot of blackmail pressure, if you will, that if you join this association, we'll be examining your company. What do the remaining 21 members do, given that letter and then now the heightened political pressure that's on them?
So I think blackmail, we definitely saw some people use that phrase. I think that's probably a pretty harsh description of it. What the senators are basically saying is, if you're inadvertently financing things like terrorism, we're going to look at your business overall, which you can debate that, but I do think there's probably a reasonable position there. One thing that's kind of important here is Facebook really doesn't want to own Libra on its own. It's very important for Facebook to say this is a consortium. Facebook is not, replacing your, world currencies with a Facebook dollar. What we're doing is working with some of the best and brightest names in finance and tech, and we're putting this thing forward. And so the hope is that this is going to be a broad coalition. What we have left right now are basically a bunch of crypto companies, as well as companies that do not necessarily have as much at stake. In other words, they don't have like a giant payment business that could get, scrutinized by a, congressional committee. I think the hope here from Facebook's point of view is, Facebook continues talking about this. Mark Zuckerberg goes to Washington. He begins to address regulators' concerns. And slowly but surely, you have some of these guys, Visa, MasterCard, maybe they come back on board. They don't necessarily want to stand out there with Mark Zuckerberg while he's getting, pelted with questions. But maybe down the road, as this thing becomes more real, you start seeing some adoption. I think that's the hope. And, we'll just have to wait and see.
Do companies not want to join because of the regulatory pressure, or because being associated with the name that is Facebook just isn't a smart strategy right now?
Yeah, I mean, I think both of those are possibilities. I mean, we're seeing, as we said in the earlier segment, Elizabeth Warren basically trying to use the kind of this is one point of view, but could be arguably using the relative controversial qualities of Mark Zuckerberg to attract fundraising and bring on supporters. Clearly, Facebook's super polarizing, and I think that's an issue. I think the other issue here is that it's not entirely clear what Libra has to offer for some of these companies. Companies that have really good businesses kind of working within the traditional financial system. I mean, and we don't know how far out this is. I mean, this could be like a really speculative thing that's going to, really excite the kind of finance Twitter and financial nerds and for good reason, because it's really cool. But if you're sitting, from Visa or MasterCard or Stripe or one of these really established companies, you might ask yourself, is this really worth the trouble? I mean, how does this help our business today?
Bloomberg's Max Jafkin on all things Libra. Thank you for joining me. And coming up, taking on WeWork. With the biggest name in shared office spaces struggling, competitors are poised to pounce. We speak to the CEO of rival Industrious next. This is Bloomberg. Before WeWork's IPO went belly up, it was the hot name in tech meets real estate startups. WeWork's the largest private sector tenant in New York and London, thanks in part to snagging customers with free rent and rich broker commissions, moves that helped it get past its competitors. But now its rivals are rushing in to take advantage of WeWork's current struggles. One such rival is Industrious, and they say that using management agreements instead of outright leases will help set them apart from WeWork. Joining me now for our work-shifting segment, it's the co-founder and CEO of Industrious, Jamie Hadari. Jamie, thank you for joining me. First, talk to me about sort of the upheaval that WeWork has caused to the industry.
Thanks for having me. Maybe let me start just to define quickly what Industrious does to help give context to that. So we're the largest premium workplace provider in the country. We have about 100 locations across 50 cities. And within our sector, we're kind of known for three things. So we have the best unit economics in the industry, the highest customer satisfaction scores. And as a result of that, we're the first company in our sector to move from signing kind of risky arm's length leases with landlords to doing partnership or management agreements with landlords. And as a result of that, are now on the eve, probably next month or the month after, of being cash flow positive at the parent level, which is certainly different than what you see in the rest of the industry. The upheaval, go ahead.
Yeah, talk to me, give me more about your business model. You talked about those management agreements and how you differentiate yourself. So what's your business model?
So what we do is we go to landlords and we partner together to create a workplace, a sort of shared workplace complex at their building level, and then use that to positively influence the performance of the whole building. When you partner with a Blackstone or a Brookfield, it's just the quality of workplace experience you can deliver is much different than when you just sign a lease with a landlord and sort of, aren't able to coordinate with them in the delivery of the workplace experience. And it's a much riskier business, which we're seeing now.
You talked about, sort of being able to ride WeWork's coattails on the way up. It sort of was the leader, if you will, in the co-sharing workplace environment. Now that WeWork has faced some struggles, how are you hoping to also stay in the game and differentiate yourself?
I think what we see is that most companies are sort of transitioning from the experimental phase of our industry to the more programmatic rollout phase. Most companies said, I'm curious to try having a third party deliver my employees' workplace experience as a service or a product. And most companies measured how it went. So they said, how engaged are my employees? How happy are my employees? What's my employee attrition rate when a provider like Industrious does this for me versus when I do it myself? And the reality is most Fortune 500s, most big Silicon Valley businesses in the last year have come to the conclusion that they got as good, if not a better outcome, and they're all starting to double down their utilization of workplace as a service. So these WeWork struggles come at a kind of odd moment because you see the industry growing incredibly quickly, but the largest provider in the industry, for reasons sort of unique to their own management style and some of the strategic decisions they've made, are having to pull back on growth. That's providing a very interesting interesting moment, because if you look at a Seattle or a Dallas and there's 400,000 new seats of demand coming online, WeWork is going to put 250,000 of those seats online, and now they're going to add 0 new seats. It's not clear what's going to happen, but obviously for providers like us, it's an interesting moment and an exciting opportunity.
The biggest complaint from the street is this is an industry that has not been tested in the case of a recession or a downturn. How are you protecting your downside risk?
So I think there are some good arguments to be made the industry will actually perform very well in a recession in terms of companies using that as the opportunity to move more forcefully into outsourcing their workplace needs. But the reality is, what we always assume is that this industry will perform like hotels or airlines or, in fact, workplace operators of yesteryear in a recession, which means about a 9 to 15% revenue decline. And the key is to build a business with margins. Industrious' margins are north of 30% at the unit level that could withstand that kind of revenue hit. And the problem is, of course, providers that haven't focused on profitability, haven't focused on building those healthy, sort of sustainable margins, because then a 12, 13, 14% revenue decline could be a problem.
So what are your updated numbers on being free cash flow positive and profitable?
Our updated numbers on that, so we're about a month or two away from that. The way that this has worked is our company has grown revenue at about 120% a year. Every year, 5 years in a row, we're going to grow revenue at probably 120% next year, but we've been disciplined in our overhead growth, and I think you don't always see that in these highly funded Silicon Valley businesses, but for us, we've made it a commitment to grow overhead at 55, 60% a year, and if you just think about how that works, if you're going to grow revenue at 120% and your overhead at 60, you are going to become a profitable business pretty quickly, and once you are profitable, it goes very quickly from there, and that's what I think the next year or two has in store for us.
Jamie Hidari of Industrious, thank you for joining me.
Thank you.
And still ahead, while IPOs for companies like Lyft and Uber didn't wow investors, Pinterest sure did. And now they're getting ready to reap the rewards. That's next. This is Bloomberg. In a year of some big-name lackluster tech IPOs, one has stood out. It's Pinterest. The social media discovery site is the 5th best public debut among technology and communication stocks, and its early investors will get cash in on Tuesday. That is when the 180-day lockup expires. Here to tell me more about what is behind Pinterest's success, it is Bloomberg Intelligence Senior Analyst Jitendra Woral. I love the title of your latest note, which talks about how the second quarter momentum can really carry the stock through into the second half. What are the fundamentals driving that momentum?
So they have been investing a lot actually in tools in the background to improve recommendations for the users, to make tools for advertisers to upload product catalogs and things like that. So we're seeing momentum there in terms of how these tools are actually helping them scale both usage and revenue. And yes, the momentum should continue in the second half. The difference though is going to be last quarter, that strength was a surprise. This second half, it's going to be an expectation.
So you talk about scaling. When do we expect them to start scaling?
It's still an investment year for Pinterest, despite of their strong quarter that they reported last year. And it's mostly because, the strength in international, the ARPU differential that they have to its peers, and also conversion of some of these new ad units, video being one of them. It'll take time. Basically 2020 is what they're really priming the pump for. And in international markets, like you can see strength coming from Canada, from Western Europe, and those things would actually add up to the 2020 expectations. So they're really setting themselves up well for 2020. That does come with some volatility in the second half as they ramp up and sort of prepare for that.
And one thing that sets out Pinterest from some of its other peers is that profitability is visible. When do we expect them to turn a profit?
So on an adjusted EBITDA basis, it should be next year. It'll take a couple of years from a GAAP basis, but like you said, compared to other names, the visibility was definitely higher in Pinterest, and really they have shown that they can manage these costs well, and that's what sort of perception change that happened. Now, can they hold that perception in the second half? That's a question mark, but given the investment year, I won't be surprised if there is some volatility there. But as a business model in general, because it's an ad-driven business model, longer-term margins should be high.
And given the path to profitability, how has that been reflected in the valuation relative to its peers?
And that's a good point, and that's one of the reasons why you see hesitation from a consensus standpoint, because yes, it's a good, strong, long-term growth story, but at the same time, the valuation is higher than its peers. We have seen a correction in the stock in the last couple of months that has brought it down, but it's still higher. So it's gonna have to show that consistency and more confidence in that long-term story, that the opportunities that are presented in front of them before consistently sort of like justifying that valuation.
Only 30 seconds left. Key note that you need to hear on the earnings report October 31st.
Continued progress on the engagement side of things, and really how new advertisers are coming into the platform. Because so far it's been skewed by advertisers spending more than before, so they're probably seeing better ROI. But how are they scaling those new advertisers?
Bloomberg's Jitendra Worrell, thank you so much for joining me. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.